Good day, everybody. It's Adrian Cronje. Thank you for your time today, Friday, March the 27th. I want to start by acknowledging that there is no one listening today, nor anyone I know, who is not somehow impacted by what's happening. We are all affected somehow. The novel coronavirus pandemic indiscriminately affects our entire population, and these are highly unsettling times. Many businesses, having ended 2019 with bumper profits, are suddenly in crisis management mode, quite literally overnight. As our chairman, Robert Balentine, pointed out last Friday, the velocity at which things have changed is simply breathtaking. Today, in addition to updating you on our market insights, we will also respond to some of the many questions we've received from you this week, so that you can prioritize the things that are important right now: your health, your family's health, and your business's outlook. Let us start with a brief market update, as I'd like to recap some of the key points of emphasis we shared in our communication on Tuesday. Then I will address your questions submitted in advance of this webinar and close with what topics we'll be covering next week. Our market update. The gist of our message on Tuesday was, don't panic. This is not going to turn into a Great Depression, despite some of the apocalyptic headlines. Rather, this is going to be a short but very sharp recession. The speed of the coronavirus stock market crash was accelerated by the oil price shock driven by Russia and Saudi Arabia. Unfortunately, the economic pain will be real and severe. As we expected, yesterday's jobless claims were staggering. The much-anticipated $2 trillion fiscal stimulus bill is being enacted, and this historically wide-sweeping piece of legislation covers individuals, businesses from small to large, and nonprofits. It looks large enough to make a difference in the areas that matter. More stimulus may be necessary in future, and we will of course explain the details as they unfold, especially what it means for business owners throughout the country. This week, stock markets experienced an epic rally. This slide shows the market movements on Tuesday and Wednesday in context, but if you piece that together with yesterday's gains, Tuesday, Wednesday, and Thursday were the largest three-day gain for the stock market since the early 1930s. This adds fuel to the points we made in our note on Tuesday. Panic is subsiding. 2020 is not 2008, and markets may be in the long process of forming a bottom. We wish to emphasize that this bottoming process will take time, and it is still too early to play outright offense from an investment policy standpoint. But we are staying alert to abundant opportunities, and we will of course keep you apprised of when we do act. Ultimately, the tide will turn for markets decisively once it becomes clear that we have flattened the curve on this pandemic so that it does not overwhelm our healthcare system. The news, unfortunately, on the health crisis continues to deteriorate. This is likely to continue for the next days, and the headlines may get worse before things start to show signs of stabilization. In fact, we learned yesterday that the United States now leads the world in confirmed coronavirus cases. But we're taking aggressive steps as a country to bend that curve. And once we've taken those measures and it becomes clear that they are effective, the markets will really be able to look through the recession to the other side. And that's when we will lean into investment opportunities decisively. Much depends on how widely and quickly we can make testing available, how we are able to provide protection to doctors and nurses on the front line, and how we balance the need for the economy to restart without risking a second wave of the pandemic. While the numbers are staggering, our healthcare system is more resilient than those of Spain and Italy. The crisis in New York City and state remains a bellwether for us as we assess the outlook. I'd now like to shift gears to answer your specific questions. We know these are trying times, and there's much concern, uncertainty, and apprehension. We strive to do our part to keep you informed of our market and economic observations, and as such have increased the cadence of our communication. If you are interested in following our market updates to stay apprised of our research and expectations, please visit balentine.com and follow the banner to our COVID-19 communications page. The questions we've received from you all so far have focused on three key themes. Firstly, the economic impact of the coronavirus. Secondly, market volatility and recovery. And thirdly, our investment advice that is informing the way in which we are thinking about our strategies. Given the limited window of time we have together today, we've selected 20 questions to answer. Let's turn our attention to the first theme, surrounding the economic impact of the coronavirus. Clearly, the toll from this crisis will be enormous. There is an economic catastrophe facing so many American families living paycheck to paycheck. Weekly jobless claims spiked this week, shattering previous all-time highs by nearly 5 times. Whereas the peak in 2008 was around 695,000, this week's claims hit 3.3 million nationwide. It is hard to believe we were celebrating a 50-year low unemployment rate just 3 weeks ago. Unlike 2008, the Federal Reserve and administration have acted quickly to blunt the potential of this sudden economic shock to become a systemic liquidity and solvency crisis. Acknowledging that it will take some time to recognize when the rate of new coronavirus infections has begun to slow, they are using all their policy weapons to ensure capital markets are functioning and to stimulate economic demand in an effort to limit the fallout. A question we received on the economic impact is, now that we think a recession is imminent, how severe and how long do we think the recession will last? Let me make a couple of observations in response. Firstly, history shows that exogenous shocks, which are relatively rare, typically hit the economy harder in the short term because of the unforeseeability leading to chaos and panic. However, unless they lead to structural problems, they generally bounce back more quickly. Secondly, our view is that the coronavirus will impair certain industries, likely to the point of bankruptcy in some cases. However, with the strong fiscal and monetary support being provided, we expect those to be a bridge to the other side of the crisis, leading to a relatively quick rebound for those industries that were not permanently impaired. On an individualized basis, there will be fallout for players who were over-leveraged, even if their industries are not as hard hit. Unfortunately, crises often serve as a reminder of the pitfalls of using excessive leverage. Our view, fourthly, is that most of the economic pain from this likely recession will be felt during the second quarter, with GDP contracting by as much as 10%, but that, given the facts before us today, it is possible to begin seeing a recovery late in the third quarter and early fourth quarter. This morning, we received an additional question that was sent in to us asking, as many are looking for suggestions now as to how to keep the economy going while containing the virus, I would be interested to hear your recommendations on what should be done next. How could transmission of the virus be prevented while people return to work? So let me underscore the importance of this question, and let me remind everybody that we are not healthcare policy experts. The health side of this crisis is undeniably tragic, and it must be priority number one to stabilize it. However, it is also undeniable that the costs on the economy will at some point begin to overwhelm the health side, leading to even more health problems related to poverty. As a result, there is a serious discussion going on today, over the weekend, and the early part of next week on how best to determine when the time is right and how best to go about doing this. These discussions are in the early phases, but one possibility being floated about is having those who are younger and those in better health to return to work, while those showing symptoms and those in high-risk areas remaining at home, either in a working capacity or a healing capacity. As I said earlier, much will depend on our ability to provide pervasive access to testing and to protection to our doctors and nurses on the front line in hospitals so that the demand for our healthcare services does not overwhelm its capacity. There is not likely to be a one-size-fits-all solution for all areas of the country. Turning our attention now to the second theme of market volatility and recovery. Before getting to specific questions on the topic, I wish to start by reiterating that it is imperative to remain disciplined during such violent and unprecedented capital market movements. Our investment process is designed to lead us to make unemotional decisions and has stood the test of time over many market cycles over the last few decades. Our current base case analysis, which is based on our projected decline in GDP and a likely contraction in the multiple of equity market capitalization to GDP, is that the S&P 500 index could decline to between 2000 and 2050 before a bottom is decisively made. So despite the optimistic tone of this week's market, we believe there is the possibility for more downside in the short term, though the majority of damage has already occurred, and the remaining downside is relatively limited. So many of you have also wanted to know, simply, when will all this volatility end, and what does the recovery look like? I empathize with the concerns of many investors. There is much uncertainty, and that can make even the most seasoned investor feel anxious. As I said earlier, volatility will persist until the market has more confidence that we've got the coronavirus pandemic under control. Certainty will stabilize the markets. This certainty may come under positive data or negative data. In other words, reduced volatility is not just a function of positive information. Negative headlines, if establishing more certainty on the outlook, would also reduce volatility. As far as a market recovery goes, there are two features of what is going on now that need to be addressed. Firstly, the swiftness of the decline, and secondly, the likelihood of a recession. We continue to believe this market action resembles what we saw in 1987, which took about 17 months for all losses to be recovered. The difference between now and then is that there was no recession in 1987, but there is likely going to be one now. With that said, the recession should be deep and fast, and thus a quicker than normal post-recession recovery is likely to ensue. The time necessary to recover after the most recent recessions was 48 months after 2002 and 37 months after 2009. So we would estimate it will take longer than the 17 months necessary from the 1987 crash, but shorter than the 37 months required after 2009. A second question came in about the market. How much further could a bottom be based on a punitive S&P multiple of reduced earnings, historic drawdowns, etc.? And how can we come out of this if the market drop is even deeper? Our current base case is downside on the S&P 500 of 2050 based on a 10% decline in US GDP and a contraction in the market capitalization to GDP multiple from 150% to 100%. In regard to coming out of this mess, the stimulus package fosters confidence, and again, confidence will help in stabilizing the markets. The details of the stimulus package are geared toward helping us bridge the gap for individuals, businesses, and not-for-profits, and that reassurance brings a degree of certainty back into the equation for markets. How long exactly will that last? It depends on many things, especially on how we balance getting the economy going again while containing the pandemic. And this is exactly why we have a cash policy to protect people from having to reach into their portfolios during extreme volatility, ensuring that there is plenty of time for things to become clear. This first step of our process perhaps became underappreciated during one of the longest and smoothest bull markets on record, but it has been a very powerful first line of defense for portfolios in 2020. We have received so many inquiries from people about their investments outside of what we supervise at Balentine to help them take stock of their full financial picture. Our relationship managers, as always, stand ready to provide a holistic, integrated approach across our clients' balance sheets and expected cash flow. A third question came in, and it went as follows. At what point can we expect Balentine's models to kick in? What steps are we taking and/or will we take to minimize downside exposure? Well, my response to that is our models are always kicked in. We entered the shock overweight equities, and this has obviously hurt portfolios. However, the stock market exposure we have had has far outperformed the broader stock market. We have emphasized U.S. markets and growth stocks over value stocks and avoided some of the hardest hit areas such as REITs and small cap stocks altogether. This has meant that our portfolios have held up very well. This significant outperformance of our exposure to stock markets follows last year's good performance too. You will recall that in 2019, when the stock market rose significantly, our market risk building block also outperformed the broader market indices. As far as what we need to see to move to reduce equity exposure, we will need to see equities get expensive relative to bonds, which involves the level of dividend yields and earning yields relative to bond yields, as well as the slope of the yield curve. Our models today continue to tell us that there is an opportunity in equities and that this is not the beginning of a protracted bear market. The note on Tuesday provides more color on how our models work. A last question on this particular theme is, what are we doing to protect and or capitalize within portfolios? Well, as I said, for protection, cash insulation is the first line of defense. For those who have spending needs from their portfolios, top up cash reserves and ensure there are sufficient short-term fixed income investments and access to credit to see you through the next 2 years without having to disturb other areas of your portfolio. This cash policy, as I've said, has always been the starting point of our process and has truly helped to minimize the risk of permanently impairing capital over the last month by selling at artificially depressed stock market price levels. And then in terms of potential capitalization, well, we're looking at several opportunities. And again, I want to emphasize this will take time to sort out. A lot is on the table for our investment team. We have seen dislocations in the municipal bond market, high-yield credit markets, and pockets of extreme underperformance in several asset classes. Given the wide spread in returns, the opportunity set for tactically rebalancing portfolios, a key part of our investment process, looks as promising as it has in 2 decades. We will, of course, keep you apprised of when we decide to act. So now let's turn to our third theme, and that is the area of investment advice. Here, people have been asking us, well, what should we buy? What should we dump? How should my allocation shift in light of recent data? And the first question came in very specifically on, should I jump into bonds or the money market in my 401k? We would like to remind you all that 401k money is long-term retirement money. Assuming retirement is not anytime soon, stay the course with stocks. In fact, this can be an opportunity to rebalance the portfolio away from bonds, which have run up, and back towards stocks. Proactive rebalancing is an integral part of long-term approach to successful investments. A second question came in on our thoughts about risks within the municipal bond market. Are there particular states or types of bonds more prone to default that should be avoided? Well, let's remember that municipal bonds come with higher risk than federal treasury bonds, as they are more dependent on tax revenues because local governments are unable to issue their own currency, unlike the federal government. Our view is, as a result, states and municipalities with excessive debt should be avoided. Another question came in along the lines of what areas look particularly attractive given the recent market activity? What are the areas to buy? The areas that have come down the most look most appealing on the surface. Good examples of those might be the value areas of the financial sector and the energy sector. However, there is a reason that these have come down the most. There are questions of survivorship bias in some of these areas. There is far too much uncertainty to make educated investment decisions at this point with regards to those particularly hard areas. We would also like to remind everybody, as we did on Tuesday, that often those areas that led us into the crisis take a long time to recover post-crisis. For the rest of the market, we continue to look at which areas may have the best risk-reward dynamics, as I mentioned a moment ago. Another question went along the lines of, is there a particular level on a particular index? For example, the Dow Jones Industrials is most frequently cited, at which point we would increase our exposure to stocks. Well, our answer to that is emphatic. We would use the opportunity to potentially move proceeds to areas we think are poised to outperform based on our model-driven approach, and there is no specific level at which this is assumed to be the case. Our models, as a reminder, look at underlying fundamentals across a broad range of criteria, including valuation and momentum, and they will always guide our decision-making. More information on how our models work can be obtained on our website. The bottom line is we do not and never have tried to subjectively time markets. That is a fool's errand. We use our discipline to objectively confirm, unemotionally, when to take action. Another question came in asking us to provide thoughts on gold as a safe haven asset with potential for a price spike from the stimulus package, especially given the recent price jumps. We do think that there could be a compelling case to be made for gold in general. However, it is notable last week during the days of peak panic, gold actually sold off as well, so did not provide its safe haven quality that so many thought. However, over the long term, we would acknowledge that all the stimulus thrown at the economy today to provide it a lifeline may lead eventually to rising inflation when the recovery comes, particularly as the world continues to rethink the integrated global supply chain that has driven global economic growth over the last 2 decades. However, per our investment process, in order for us to recommend investing in gold, we need to convince ourselves that that investment would outperform where we are currently invested before making that decision, and we are not there yet. Do you believe that recent events should drive a change in asset allocation between domestic and international/emerging markets? Was a question that somebody asked, and our answer is not yet. In fact, we expect the international markets, especially the international developed region, that is Europe, Australasia, and the Far East, to fare worse during the brunt of this crisis. With that said, our beliefs are not as important as our model discipline. We look to our models within market risk to determine where we should be positioned, and those models are pointing firmly away from international assets at this time. So even if we did believe that international markets were poised to outperform, we would stay disciplined and true to our process rather than any subjective thoughts on this matter. The next question went as follows: should the current environment drive us to move away from index funds towards company-specific selections? Possibly is our answer, but not necessarily. Although it is a possibility that active managers and individual security selection will outperform during times of higher volatility, we would be quick to point out that any expected excess return is very much dependent on which manager is picked. So not only do you have to make a correct call to go to greater security level active management, but the actual manager selected has to be correct as well. Even under regimes of higher volatility, the vast majority of return will be driven by the strategic asset allocation of a portfolio, not its individual security selection. And the final thing I would add in response to that question is, as I said earlier, the opportunity set to add value by actively rebalancing index funds today is as promising as it has been in 2 decades. The next question related again to the recent price turmoil in the municipal bond market. The question was asked, should I just ride them out to maturity? This is exposure to municipal bonds without worrying about price fluctuation. We would be quick to point out that we have the utmost confidence in our active municipal bond managers to steer their portfolios to the securities with the best risk-reward dynamics to account for the increasingly selective environment. In fact, their high-quality biases served them well during these times of stress. The Federal Reserve, I will quickly point out, has also indicated that they will take steps to ensure the municipal bond markets will have ample liquidity to continue to function. So the short answer to that question is yes. What is the liquidity of ETFs, that is exchange-traded funds, like during times of stress? Is now a good time to average into high-quality stocks with strong cash flow and a very low probability of dividend cuts? This has been a very interesting time for us to watch the liquidity across various capital markets and specifically exchange-traded funds. As you all know, we lean on these heavily to implement our portfolios, and for the most part, liquidity has been just fine during a highly stressful period. Bid-ask spreads have been in line with the bid-ask spreads of single securities, and the arbitrage mechanism that keeps exchange-traded funds in line with the underlying NAV of the securities has continued to function quite well. Many have worried about the proliferation of exchange-traded funds in recent years and whether these implementation vehicles would stand up to a stressed environment, and we believe that they have come through this crisis very well. We do believe that high-quality stocks with strong cash flow are likely to outperform, and right now our portfolio is tilted toward those in a highly diversified way in the form of growth stocks. Again, empirical evidence shows that asset allocation will drive the bulk of your return versus individual security stock selection. We've had some questions come in about how we as a firm are taking advantage of the situation with regards to tax loss harvesting. Well, over the last 2 weeks, we have been particularly active in this area. As our holdings in our strategies decline in sympathy with the market, we have been swapping into similar holdings to take tax losses to help our taxable clients protect future taxable gains. We have added significant after-tax value for our clients in this regard over the last 2 weeks. Remember, in doing so, we replace like-for-like market exposure, so this does not compromise our ability to maintain our desired exposure to the market for the eventual rebound. And then lastly, there was another question related to cash, and it went along the lines of, I'm a little torn on how much cash we need in reserve and how much to funnel into the market. What is Balentine's recommendation? Well, the short answer is we believe 2 years of cash and short-term fixed income is appropriate to ride out market turbulence. Any extra cash over and above that level can be thought about as the potential to be funneled into the market. Of course, 2 years of cash can be arrived at by raising cash and also by lowering spending. In other words, less spending means the same amount of cash can last longer. We have a very detailed and deliberate approach to our cash policy. My partner and Deputy Chief Investment Officer, David Damiani, published an article on the case for cash over 5 years ago. It has been critical for our relationship managers to help our clients' ability to stick with their plan during this sudden, unexpected crisis. In closing, I'd like to remind everybody that we have a deep bench of subject matter experts at Balentine to help bring clarity to all that's happening in the markets, the economy, the stimulus packages, and the myriad opportunities for business owners and individuals as we look eventually to begin to capitalize on this turmoil. While these are challenging times for all of us, there are also silver linings. In the upcoming week, we will go deeper into financial planning opportunities for individuals and families. We've released a blog that touches on this entitled History Rhymes, but it does not repeat itself, authored by my partner, Rob Ragsdale. And next week, our head of financial planning, my partner, John Madison, a blog will expand upon the several generational financial planning opportunities this turmoil has presented. Of course, we are business owners ourselves, and we know and feel and recognize that many business owners are highly impacted. As I said earlier, so many companies enjoyed bumper profits in 2019 after a long booming economy, and all of a sudden, within the space of a couple of weeks, have moved from growth to survival mode because of 2 exogenous shocks, a global health pandemic and an oil price shock. My colleague, Dr. Mark Bell, and I, and as a reminder, Mark oversees business advisory within our multifamily office services. We will be releasing a guide for business owners, and I will deliver a presentation to the Vistage CEO and Business Owner Network nationally next Friday, which we will share with you all early next week. Mark and my article will address 4 key points. Firstly, the aspects of a resilient business and a resiliency plan for your business. Secondly, Mark and I will reflect on some of the lessons we both learned from 2008 as we help business owners navigate that particular crisis. Thirdly, we will keep you informed on the direction of government assistance for small businesses. And by the way, on that point, we have just released an article explaining the fiscal policy stimulus and the loans that are available through the Small Business Administration, and that article is called Opportunities for American Small Businesses, authored by Mark. That may be of immediate assistance to you as you navigate today and the early part of next week. And then the fourth and final area of our article, we'll be reflecting on managing a business for a world beyond the crisis, where the opportunities might lie. So please take a look out for that. There is more to come. As always, our website is a treasure trove of resources for you on a variety of topics. As a reminder, that can be found at balentine.com, and if you click on the Insights link, you'll be able to see a corner dedicated to our communications surrounding the coronavirus crash. As always, if our time together today prompted additional questions, please send them to your relationship manager or to info@balentine.com. We will route them to the correct person and respond within 24 hours. Thank you very much for listening, and stay healthy.